Macro analyst and financial pundit James Rickards recently forewarned of a potential impending financial panic in the lead-up to the release of his most current and last book in a series called Aftermath, in an interview done at the Nasdaq Stock Exchange headquarters in New York. Hey people, welcome back to our channel. In today's video, we will be looking at everything you need to know about Jim Rickards' last warning. But before we start, make sure to subscribe to our channel, turn on the notifications, and most importantly, watch the video till the end. Let's get started. The best-selling author believes that the US Federal Reserve may have raised interest rates during the past few years from 0 to the present 2.25 to 2.5% as a ruse to provide it the chance to later lower rates in case of second probable economic slump. In previous financial panics, Rickards has frequently been on the front lines. He served as the long-term capital management hedge fund's principal legal counsel, which is now defunct. The company gained notoriety for the $3.625 billion rescue the Federal Reserve Bank of New York orchestrated for it after it suffered significant losses as a result of the 1997 and 1998 financial panics in Asia and Russia. Since then, Rickards has watched from the outside as the 2008 financial crisis unfolded and was followed by another rescue, this time coming straight from the US Treasury. He believes that if we fast forward another 10 years, we may soon be in the midst of another significant economic crisis, but this time the problem will be too huge for even central banks with government backing like the Fed to bail us out. In response to a question about what he anticipates the Fed may do if there was another financial crisis, Rickards stated, "They're going to freeze accounts and stop the stock exchanges because they won't be able to bail it out again. The Fed issued $4 trillion to bail out the system last time, and I was standing with our modern monetary theorists to say that you're not going to be able to create another $4 trillion to bail it again," the speaker continued. According to Rickards, this will ultimately lead to the Fed turning to the IMF. Due to the IMF's position as effectively the central bank for central bankers in the current global economic framework, he feels that such a move might have a lot of repercussions. In the event of a future rescue, several central banks from all over the world might be forced to look to the lone remaining location with a clean balance sheet for a liquidity injection in the form of CDRs, or what Rickards refers to as world money. Rickards asked, "Did anyone at the Fed think that we'd be in this scenario of having a non-normalized balance sheet in 2019? In hindsight, there was no typical economic cycle justification for raising rates," he claimed, "unless you saw inflation or capacity and labor market restrictions putting a damper on market growth. Given that you have 700 million people in China prepared to work for next to nothing, he believes that there is little danger of capacity restrictions at this time. The Fed is hiking rates to erase the harm of taking them so low and keeping them low for so long it's getting ready for next recession," Rickards said in his conclusion. "The current run may last longer than anticipated, but when it comes to an end, it will be the worst crash ever. It will already be too late by then." Where did we come from? Jim Rickards, a former attorney who now works as financial pundit and author, spent 50 years working for some of the most illustrious financial organizations in history, the CIA too. Madeline Albright and Tim Geithner were former students of the Paul Need's School of Advanced International Studies in Washington, where Rickards studied international economics before switching to law in the 1970s and landing his first job as a tax advisor for Citigroup. As a result, he went on to work as general counsel for Greenwich Capital Markets, one of the top bond dealers in the US at the time. The growth of derivatives market and the ensuing financial boom made it a favorable moment to work in finance. He claims that in 1993, after 10 years, he made the decision to depart for a startup. In reality, the startup was none other than Long-Term Capital Management, arguably the most well-known hedge fund of its time, led by the best bond derivative trader in the world at the time, John Meriwether, and backed by the fathers of modern financial theory, Myron Scholes and Robert Merton. All of these figures were surrounded by former and present-day financial luminaries, including former vice chairman of the Fed David Mullins and Matt Zames. "I was already in the major leagues, so for me, it was like going from the Mets to the Yankees," says Rickards, who claims he was sufficiently confident. In fact, LTCM produced returns of 21, 43, and 41% in the first 3 years, increasing its assets to $7 billion US. Rickards claims to have designed the legal framework for the first sovereign credit default swap while at LTCM. Deep financial tinkering that occurred long before Blythe Masters ran with the idea at a JP Morgan offsite weekend in Boca Raton in the mid-1990s. According to Rickards, we executed the first CDS. My task was to determine what a country's default signified. I essentially had to sit down with a blank piece of paper and consider every possible way a nation could steal your money. It was a happy period. When the Russian crisis struck in 1998, things started to turn nasty. The Federal Reserve and a group of dealers helped bail out LTCM after it suffered multi-billion-dollar losses and faced the possibility of destroying the financial system. This is the first and only time in history that the US top financial regulator has had to save a hedge fund. None of the three in actuality. Merriweather does seem to have been a decent man according to Rickards. When you're that successful, people create up mythologies around you. The master of the universe thing. Merriweather is a really lovely man, although he tends to be quiet. He is not at all bombastic, and he bases his decisions on consensus. It was LTCM's lack of cognitive variety that made it weak. Running only on talent was insufficient. The men behind LTCM had attended the same universities, learned from or shared the same theories with one another, and had similar blind spots. According to Rickards, LTCM would have been better off firing a few partners and hiring a landscape gardener to offer a different perspective. First, Jim Rickards thinks that the stock markets are currently in a huge bubble by any standard. According to him, a reliable gauge of how much money has been invested in the stock market in relation to the size of the economy is the market cap to GDP ratio. According to him, multi-billionaire Warren Buffett uses it as his go-to signal to forecast market crashes. According to Jim Rickards, when the dot-com bubble was at its height, the chart was at its highest point, and Buffett anticipated a fall. He was proven to be correct. For 15 years, the market did not recover. The indicator is currently 113% greater than it was during the dot-com bubble's peak, which Jim interprets as meaning that the US stock market is currently receiving more free money than at any other time in history. When this is gone, the market will collapse more severely than it did during the tech bubble. The margin debt graph displays how much money investors borrow in order to make stock market investments. The graph demonstrates how just before the 2000 crash, borrowing for stock investments caused the margin debt to be nearly double to $500 billion. The average person's debt to net worth has been increasing. The debt increased once more just before the 2008 financial crisis as a result of customers leveraging up their accounts. According to Jim, margin debt levels are now twice as high as they were prior to 2008 financial crisis, when the market fell by over 55%, and this excessive debt is a matter for concern. Today, there is almost $1 trillion worth of borrowed money floating around in the stock market. They have also increased from their levels during the trade war. As a result, he believes the subsequent crash may be among the swiftest and most violent corrections in history. Jim claims that Robert Shiller, a Nobel Prize-winning economist, created the Shiller P/E ratio as a bubble indicator. With that, the video has come to an end. Let us know what you think in the comment section to help us expand our community and attract more people who share our interests and are eager to learn. Please hit the like button and subscribe if you thought the video was interesting. Till then, bye.